As an example of such an overhang, we focus here on KPPC's situation. KPPC's history is rooted in Stone Arcade acquisition, a SPAC that IPO'd in April of 2005 at $6 per share. A SPAC is a special purpose acquisition corporation, a public empty shell company formed to make acquisitions. The company listed on an exchange by selling investors 20 million units, each consisting of a common share and 2 warrants. Warrants are very much like options. Stone Arcade acquired International Paper's craft paper business in January of 2007, and since then has completed a number of acquisitions, so it's a roll-up in the paper and packaging industry. Its warrants had a $5 strike price, and they expired on August 17th. At that time, warrant holders could choose whether to exercise their warrants or not. If a warrant holder wanted to exercise his warrant, he had to send the warrant and $5 to the company in exchange for a newly issued common share. The warrants could cause significant dilution to the company's existing shareholders. Let's say, for example, that the company could earn $1 per share in 2010 based on the current share count. If all the warrants were exercised, the share count would effectively double, and each shareholder would now have 50 cents in earnings per share. Presumably, the company could invest the proceeds from the warrant exercise in projects that would generate the same returns as its existing equity capital invested. But the company has said that it's going to use the proceeds to pay back debt, which costs LIBOR plus 3% or something around 3.5% annually. So the blended average return is going to be somewhere in the middle between LIBOR plus 3% and what the current equity is earning, and existing shareholders will not be happy if a lot of warrants get exercised. Disappointed shareholders may create significant selling pressure in the stock, so based on that uncertainty, it doesn't make too much sense for a lot of new holders to invest in the stock before the exercise. Instead, they may prefer to wait on the sidelines, which can create a lot of pent-up demand for the stock, and once the overhang is over, they may jump in and buy shares.